We are live. It's 10:30 a.m. on the West Coast, 1:30 p.m. on the East Coast. It's value after hours. I'm
During
joined as always
hours.
by... Yeah,
Never mind that.
Change that name sometime. Bill Brewster and Jake Taylor. What's happening, fellas?
It's a vibe, man. We can't change the name.
Oh,
I agree.
yeah.
I agree.
Good point. How
It's
we doing,
an interesting
brothers?
market. There's a lot of interesting stuff going on.
Yeah.
Interesting times.
Looks like Elon realized that, when you bid 54.20 and nothing happens, sometimes you have to pay 54.20. So I guess he's proposing to pay what he bid. I thought that was the bid, is the proposal, but I don't know. I'm confused these days. Some tell me he's a tech genius.
Twitter's going to think about it too. Twitter's going to going to mull it over.
Right.
Yeah. Did you read through those text transcripts?
Some of them, yeah.
I did, yeah. A few of them.
Little, maybe some of the shine coming off of the.
Well, I don't want our text messages getting released either.
Oh God, see what kind of buffoons we are.
Well, to be fair,
Just
there's no shine on us. Yeah.
Yeah. Good point. Yeah.
I just
stay down here.
I just think it's so I think the whole thing is so interesting because it was so obvious if you paid attention to Twitter. And I can understand people that don't live on Twitter didn't think it was obvious. That's a fine take. But for the people that are on Twitter often, this is all completely in the open. And it was one of those where the Musk defenders were like, well, don't trust your eyes. It's no, I know what happened. It's all here. And I don't know. It's wild. It's wild how convoluted people's arguments came. Well, what happens if he just doesn't listen to the judge? Where the fuck did that come from? Who? Oh, that was just made up. And of course, he's not going to say, I'm definitely going to listen to the judge. You just let the public run with a narrative. But man, it's an interesting issue, and different people seeing the facts way differently. Probably a lesson in there.
Well, I mean, I could kind of get behind why they would think he's routinely violates the Twitter sitter agreement. It's not that big of a stretch to imagine that he might not follow everything to a T.
I don't know, man. You can get in contempt of court. You can actually get thrown in jail for that shit. That's not the Delaware court system and the federal court system. When you get to the level of the appellate court, this isn't just cute stuff that people don't listen to. This is the law of the United States. And if we're not going to enforce that, then the entire market deserves to re-rate massively.
That's fair. I can kind of understand where they're coming from on that, though, with previous behaviors.
But he had a judgment and he ended up paying it. He thumbs his nose at the SEC. I just think it's way different when you're talking about the SEC and a potential fine and the Delaware Chancery Court and all of your corporate affairs being in Delaware for the most part. These are not the same.
All right, that's a good observation.
Well, he's got to complete. If they rule it, he has to complete. He's got to complete. Or he's paying that money one way or another. So get out in front.
Yeah, well, I guess people would be like, "Well, what if he just doesn't pay?" It's
there's a process that just gets gone through.
Yeah, that's right.
You can resist it a long way, but ultimately, there's only one way out. Let's just give some shout outs. London, Santa Monica, Hofstein's in the house.
Hey, shout out to him.
Germany, Lincolnshire, Chapel Hill, Lima, Peru. This is cool. Lisbon, Portugal. Reading a history of Portugal at the moment. Portuguese shipping. Nashville, what's up? Toronto, Halifax. Awesome. That's a good spread.
Especially since it's only 10 people.
I thought we had a dozen.
I don't know that we ever got that high.
We didn't get a dozen out at
Look, we're going for quality, not quantity.
That was a good crew, though. That was a high powered three.
Yeah,
that we had there
per capita, it was off the charts.
Yeah,
that's right.
Yeah. We had the dudes from there's Seawolf now, but whatever they were in The Big Short, Portico. Although if someone has actually played you in a movie, that's pretty legit.
That's what's up.
I hung out with somebody that knows them this weekend, and I don't
didn't
know.
skip Ireland.
I gotta get those guys on a podcast. They sound like they're really fucking fun.
Sorry, Colin, I skipped Ireland, evidently. Ireland, Sweden, Leeds, and Dubai. Iceland. What's up, fellas? Romania. Wow, this is good spread. Sorry, buddy. Keep going.
It's okay.
What do we have? So we got a little mini Twitter teaser out of the way to start, but what else we got on tap for today?
I got a few things. Ray Dalio.
Never heard
Done.
of him.
Turns out cash isn't trash.
But he's had a banging year. Like he's up 30% for the year. He's going to ride off into the sunset.
How does okay, all right. Well, we can unpack that, but I have questions.
Well, let's do that. I've got a list of things to go, but that's one of them. Well, what's the question? I'll answer it.
How, with bonds down like they are, and my understanding of risk parity being a lot of levered, low risk.
How do they do it?
How do you get up 30%?
I don't know.
I don't know, but I think they probably had some decent commodity exposure. I don't know.
Okay. Well, how levered were all of these things to be able to put that together?
They've got a few funds, right? That's
the other question is which fund are we talking about?
I just know that after having some conversations with people smarter than me, I think that they are very, very disciplined to what they do. That's and I don't think they deviate in a large way without having a lot of data to support the deviation. So what I do know is that I don't know, but I think it's probably pretty rational.
I can't comment. What about the cash is trash and then down 30%? Now cash is back on
that. I find
boys.
Funny.
That is funny, right? He says it's gone to neutral. What he did explain a little bit. What he said was that I guess cash was like way below the rate of inflation. So that's the reason for him saying cash is trash. And now he's saying it's neutral.
Really? My cash and my checking accounts yielding 9%?
Well, there's probably some cyclical chunk of that inflation print, right? There's like coming off a high. Or, every single chart looks exactly the same, where they've had this huge ramp and the like return to earth. So that must have filtered through. Like everybody's got that sugar high. All of the Fed cash has been pumped into the system. Everything's shot to the moon and then run out of fuel halfway up and is returning to earth. And I think that like probably the real number is around 3 or 4% or 5%, wherever it is now. I don't know. That's what he's saying. I'm not necessarily saying that. That's what he's saying.
I just think it's interesting that when cash is trash, it outperformed a lot. And like, I'd be much more inclined. I don't know. You look at like investment grade bonds, they're finally yielding something. If you get any duration on that basket, like I don't think we're going to live in a inflation environment like this for an extended period of time. I don't know, 7 to 10 years getting some sort of investment grade return, I think makes in my pea brain some sense.
I'd be very curious to go back and talk to people in 1972 and whether they thought that they would see inflation for the next 10 years or not.
We've already seen that, right? I saw that somewhere where they showed that every year nobody believed it was real.
It was transitory.
Yeah. Nobody believed it the entire way through until right near the end when everybody was like, this is going to go on forever. And of course, that was the turning point.
Yeah. I mean, look, it may. I don't know. What the hell do I know? I haven't called anything right. I don't know why anybody listens to me on anything.
It's okay. It's a podcast, sir.
I got another one here. Greg Abel, vice chairman of Berkshire, waded into the market over the weekend, bought a $68 million. He's been paid $75 million by Berkshire over the last few years, plus he's sold 1% of Berkshire Energy back to.
He bought $68 million of stock.
That's the.
Is this real news or fake news?
No, that's real news.
Of Berkshire?
That's a fucking buy.
Of A's too. He wants the voting shares.
Good for him. What a pimp.
I mean, I kind of thought they should have just done a stock swap anyway for the BHE.
Was stock. It like $800 or $900 million worth? 809, something like that.
Yeah, I think he was in that.
He was
range.
given the choice for it.
Oh, was he?
That was what I understood.
Come on, Buff Dog would have. I don't know if he was given the choice.
They like them to buy their stock.
What's the difference, though?
They're pretty stingy with the stock.
if you're gonna just straight swap it,
Well, you got to issue new stock to.
yeah, I get it. But if they're doing buybacks at the same time, then that's sort of the, taking
Well,
it out of
that might be the key though. Like, he doesn't want to issue it while he's doing the buyback. I don't know.
maybe.
He's been
Why?
pretty consistent with that.
It's 2020. You issue it and then you buy back
Yeah,
to
that is
offset
how it works, right?
dilution. And then you cite cash flow from operations with stock-based compensation. And then you don't deduct the buyback from your cash flow from operations. And then you call yourself free cash flow positive. Bang.
That's how it works.
Whoa.
That is how it works.
You just nailed the
sass.
You just nailed the gap.
And that's my topic for today. Actually, just this is the Verdad piece. I don't know which one of the guys wrote this again. I didn't look at that. Dan Rasmussen. It had a few names tagged on it, but they're looking at the predictability of growth in various different earnings measures. So I just thought I'd go through that.
Plug your ears.
The conclusion was pretty good. I'll give you the conclusion if I can pull it up quickly.
Don't bury the lead.
The conclusion was the last sentence. Oh, sorry, too hard. I'll dig it up when I do it.
Well, my topic is might dovetail nicely with that. I love this when this happens on accident because we don't pre-plan anything. But I was going through Amazon's financials over the last 15 years or so and just made some interesting observations that I thought I might share with the crew.
Did you have something move below your belt when you saw AWS?
No, this was a little bit higher level than that, but there's some movement.
Imagine 30%-ish returns on capital growing at 30%-ish with that big of a base.
It defies
What a beaut.
The laws of physics.
What a beaut. And it's going to end up being the infrastructure of the internet.
It's going to end up being a utility one day.
Yeah. What do you like? You like Zoom? It runs on AWS. You like Netflix? It runs on AWS. What else do you like? Everything's on AWS. It's wild. Fucking monster.
We'll see.
Well,
Anyway,
who's going to
that'd be
displace it? You got Microsoft.
They've never done anything.
Well, but
Google,
I mean, look,
those bozos, they don't know what they're doing.
they know what they're doing, but I don't know.
No resources.
Goog's out there.
It seems to me to be a different use case. Like if I was, if I needed something that was going in like a very heavy data analytics way, I would probably lean towards Google. But I'm not sure that outside of that they have top of mind in that particular area. Sorry, Rishi. If I'm wrong, hit me up, man.
Hit us up anyway.
Yeah, that's right.
Because we love you, Rishi.
Yeah, well, just to say hi, but that's sort of different. I don't know what I have. I've been dealing with shit all morning. I'm a mess. I'm sorry.
Well, we got Twitter going, so that was a good take.
Yeah. I don't know. It's very interesting, man. Sometimes I think that I see the ball clearly, and sometimes I think I don't see any balls at all. So we'll figure it all out at the end of all this. And when I have no money, I'll say I didn't see any balls.
When you think you see it clearly, lie down. And when you don't think you see it well, then you're onto something.
I guess.
Me personally.
Twitter I saw pretty clearly. The whistleblower was tough. And like we were saying, I think the thing that's hard about taxable money in merger arb cases is I'm not getting paid to carry. I am probably, like, if the deal plays out like I thought it was probably going to be short-term taxes.
Sure. Hopefully, you need that for your IRR.
Yeah, but you got to pay ordinary rates on that, right? And I do think that there's a fair amount of stuff in the market that's pretty beaten down. I don't think the market on average is cheap. Like I think that there's a lot of things that are arguably fair. But I think that there's pockets of opportunity. So I just
sounding very Barry-like there. Barry's got a couple of good tweets where he came out and said, looks like 2000 to him. Market doesn't look cheap, but underlying good cash flowing assets value looks cheap. Some undervalued stuff.
said that he was feeling greedy.
Yeah, that's right.
Ooh, what? Say what?
Yeah,
Well,
when did
I
he punch
just-
out like 3 months ago?
I mean, things
Not down that
have
much
gotten
over 3 months.
annihilated. Not the index. The index is sort of a different beast, which is why everybody should probably just invest in it and go home.
Still
And
down
obviously have
20-something% for the year.
Value ETF sprinkled in, if only there was such a thing.
Those all died.
Yes.
Let me kick off a little bit of
Who's your daddy?
Verdaddy. I thought this was pretty good. So they looked at, there was a paper that came out in 2001, the level and persistence of growth rates, looking at annual growth rates across all US firms from 1951 to 1997. After carefully conducting tests on multiple measures of earnings, the authors concluded that while some firms have grown at high rates historically, they are relatively rare instances. There is no persistence in long-term earnings growth beyond chance. So clearly we live in a new regime. And so they wanted to retest. So the data ended in 1997. So these guys have updated from 1997 to over the last 25 years. I guess that's to date. Testing whether those secular changes that we were discussing before have actually manifested. And so they find out of sample results corroborate the original paper's conclusions. Using the same methodology as Chan, we found little to no evidence of persistence in earnings growth beyond chance over the long term. And then now I've got to search for the great line.
So what that's saying then is that I think they use some kind of coin flipping methodology, right, for the chance. And if that basically your odds of finding those super persistent growers is not great.
There's a little evidence for persistence in revenue, but not much more than chance. And so this is the great line. When building a DCF model, it seems analysts might as well plug in the same long-term growth assumptions for a SaaS software company as when valuing a coal miner.
No way. No way. That's idiocy.
This is earnings growth, not necessarily return on investment.
Well, part of the problem is there's no fucking
maybe
earnings. So, they could grow
Well, not right
from
now.
a low base. Yeah, pretty well. I don't know.
Anyway, you should read that article. I'll give you the name of that article just so give the boys a shout out. Persistence of Growth by Brian Chingono and Greg Obenshane.
Here's the problem with that, though, right? Like, I don't know that anybody. I guess what I would want to know is what is the period that statement starts at? Because like
51 to 1997, and then out of sample 1997 to date.
Yeah, but then I need to know like the slices of the life cycle of a firm. There's just like I don't think anybody thoughtful builds a DCF that's just like, this is just like rant. I mean, like Malbison, right? Like you got to have some fade rate and growth, I think, to appreciate what the base rates are. But to look at a company that's growing,
not if you're going to get to 2021 prices.
Well,
you better not be fading anything.
A lot of that was interest rates. But
it turns out after the fact.
It's always been an interest rate bet. Still is. Still will be in 20 years.
They were finding the inflection in the S curve there.
Some may have. I don't know who's right and who's wrong. I'm not going to dunk on people that are down.
I'm not dunking. I'm not dunking.
I'm not saying that you are. No need to be defensive, dunker. Anyway.
Mother dunker.
Yeah. I don't know.
I mean,
I think that supports every other bit of research that I've ever seen. That's just growth is too hard to predict. Anything that is a quality metric tends to be reasonably hard to predict. A future flow metric is reasonably hard to predict. That's all.
So like Zoom, you might as well just plug in a commodity growth rate on
GDP.
Just say I'm never going to buy it, which is fine. It's all
Depends
in the
on
too
the
hard
price.
pile. Anything growing is too hard.
I think that that's fair. I do think that at the early stages of rapid growth, it is very, very hard to see what the future economics are going to look like. And I think that you want to wait until they stabilize a little bit before you try and make those predictions, because like it's a prediction business about the underlying. That's kind of, I would agree with that.
Yeah.
This is going to dovetail nicely into what JT is going to do.
Yeah. Well, that I get, but like to say like a Zoom or Fastly Fastly, I don't know, it's a CDM, but like Datadog's not going to grow like a commodity company. No fucking way.
Well, the commodity companies may have, like, the cycles do cycle, and it might be they might have a good run here.
Yeah, they may. I would lay pretty decent odds against commodity growth outperforming Datadog's growth of earnings over the next 10 years. I think that would be a bet that I would fade hard.
I think one of the problems is that there's assessing that competitively advantaged period is very difficult. Like, how long is it not to pick on Datadog, but like, how long is a Datadog before it becomes a toaster? Because eventually everything becomes a toaster. And so the time period it takes from Datadog to toaster will dictate a lot of the outcomes for you as an investor and what you paid for it. So I think that game is very difficult because it requires you to know what the dynamics of the industry look like out into the future. And that seems like a really hard thing to wrap your mind around.
Yeah, I think buying cheap shit codes is really fucking difficult because management's incentives are to screw you. So nothing's easy in this game.
Speaking of easy and then realizing it's not easy, that Davey Day Trader montage that someone put together on Twitter is pretty funny to just watch different little, 10, 20-second clips of him.
I had no idea he was still going.
Over the I know.
I didn't know he was still going either.
I didn't realize he was still going in 2022. I was looking at those months in 2022 saying, I thought that was last year.
That was, missing though was the Scrabble bag, which to me was the piece de resistance of the whole play. Like, you missed like the best clip.
I think he ended up picking a good company out of that.
Yeah, didn't like was it like
it was Raytheon
came out of
yeah.
Was it Raytheon?
Yeah, it was like a really good company.
It was like a value pick on accident.
Yeah.
Like 2 weeks before Ukraine was invaded.
If you're long Tesla, shout out to Samson, and you watch how Elon has done this Twitter thing, and I've listened to Galaxy Brain, he's going to get advertising synergies and it's all going into X and this and that. Don't you kind of have to wonder if this is just like an impulsive, overgrown baby that maybe is like very, very smart also, but maybe has hit the point in his life where having all these children and doing all these extracurricular things and being addicted to Twitter maybe is having some negative impacts on his brain, and like maybe Tesla should trade at us at like a slightly lower multiple because maybe the genius that you're betting on is going like a little nuts.
10 out of 4. We got shots fired.
Maybe you need that sort of stuff to come up with those ideas, though. Maybe you need to be like that.
Yeah.
I don't know if that necessarily makes you a good operator, but
what'd you guys think of the robot?
I mean, from a standing start, it's pretty impressive, but it's like, as many people have pointed out, Sony had Asimo 22 years ago that was a little bit sleeker than that, but I'm guessing they're leaving themselves. They'll have a few more announcements over the next few years that'll get it looking more like Asimo. So I'm sure they'll catch up to Asimo in the next few years. And then,
so they'll be up to 1997.
but he's already priced them. Yeah. He's priced them at 20 grand.
Yeah. No, there's one robotics company and it's Boston Dynamics.
Yeah. That's right.
Those guys are doing backflips.
Yeah. Those are robots. This thing is like some fucking side project.
I would have also accepted the one that runs around on the floor, hoovering up your
Roomba.
Yeah.
Yeah, that's fair.
Do you guys know?
That's a real business.
Is it hoovering up the crumbs on the floor or the data of the floor plan of your house?
Both.
Oh, okay.
Well, didn't Amazon just buy it? Or did they buy iRobot?
Something like that. I think iRobot is Roomba, isn't it?
Yeah, I guess. I don't know. I think they bought something. I got a Yeetie. I like the Yeetie a lot. It's a Roomba, but it's a Yeetie. It's half the price.
Having the name for the category is a big deal. Like having the
Kleenex or
having the Kleenex. Yeah.
I don't know. I do agree. I mean, I agree with you. And if we wanted to be smart, we'd call them cognitive reverence. But I think with the amount of reviews that you can go and shop things with, I'm just not sure that matters like it once did. Because I found the Edie, I looked up the Roomba. I was like, this is too expensive. And then I just read like a couple consumer reviews on the interwebs. It's this thing that came out a little while ago. I'm still trying to figure out how to use it. But you type into a Google search and it brings back reviews that people have written. And I found something for half the price that I'm very happy with. So
I'm guessing that the profit pool for that entire category can't be as big if you end up with competitors that are charging half the price as the first mover. I wonder if that applies to any of these other industries that we've been looking at.
Well, it may.
To give Musk and Tesla credit, what they have done is created this cult of people who just are so heavily invested and believe in it so much that they ignore any kind of evidence to the contrary. I've got a good quote here from Samson. Tesla bot is a side project like AWS was for Amazon.
Oh, get out of here, Samson. How's his dick taste? Anyway, I think I mean, look, Tesla's incredible. Okay. Like I have always liked the way that those cars drive. They are like one of a kind, in my opinion. I don't know if you follow Doug on YouTube. The Rivian SUV just got the highest Doug score ever. There is competition coming. Like, do not fool yourself. Now, do they have all the supercharging and all the infrastructure? No, I get it. I just think, I'll tell you what, I think if I had a big Tesla position, I'd sell it happily and move on.
There's
I'd live the rest of my life without that risk.
You know, I tell you guys, there's a lot of Teslas up around where I am. What I have noticed recently is there are a lot of Rivians, and I saw my first Lucid yesterday.
Oh,
I don't even know how many Lucids there are on the road. There are like thousands on the road, aren't there? Dozens.
Yeah, there's dozens of us. Yeah, the Rivian truck I don't love. The SUV looks pretty good.
Aren't they the same? Aren't they the same thing?
Yeah, it's got a back.
Same skin. Okay. They've got that compartment where you can stick a dead body to, which is very important.
Handy.
Yeah, the thing that's nice about electric vehicles is you get the frunk, that front trunk.
Yeah. Listen,
JT, you want to do yours before we
Yeah.
slide too far off topic here?
We're off the rails here. For sure. All right. So this is precipitated from messing around, just curious, wanted to go look at Amazon's financials because it'd been a while since I looked. And so let's start with over the last 15 years, let's go through the order of growth rate, like what's been growing the fastest within this company. So these are CAGRs over the last 15 years. All right. Coming in at number 6, we have book value at 22% CAGR. All right. You could say like book value doesn't really mean very much for a company like Amazon. I'm fine with that. Number 5, we have stock price at 24% CAGR. All right. Number 4, we have revenue at 26%. So that might have surprised some people that actually like revenue is growing faster than the stock price over the last 15 years. Number 3, EBIT actually coming in at a 27% CAGR. And so those are kind of the good news. Here's the number 2 and number 1 that might not be as good news. Number 2, full-time employees growing at 35% compound annual growth rate. That's interesting to me, all these cap light businesses. And number 1 growing at 45% CAGR for 15 years.
SBC.
CapEx. So a lot of money pouring into Amazon and building permanent infrastructure, or at least hopefully relatively permanent, but growing at a much faster clip than a lot of the other variables. So let's I thought it might be interesting to granted, okay, like extrapolation is the first tool of ignorance, and you shouldn't put anything into this, but it's just kind of fun mental exercise. If we use the last 15 years growth rates and used it for the next 10 years, what would that imply about Amazon as a company? Okay, so book value starting off at 131 billion, growing at a 22% CAGR for 10 years. That gets you to 957 billion book value. So almost $1 trillion of book value in 10 years. All right. Revenue starting off at 470 billion, growing at a 26% CAGR. That's almost $5 trillion of revenue implied in 10 years, which is about 25% of today's US GDP. So if one of every $4 of US GDP today would be going through Amazon's turnstile, that implies a relatively large business. EBIT at a 112 billion starting point, 27% CAGR gets you to $1.2 trillion EBIT 10 years from now, which is about 35% of today's $3.5 billion pre-tax corporate profits. Full-time employees starting at 1.6 million and growing at 35% clip would give you 32 million full-time employees, which is about 20% of today's civilian labor force. So imagine 20% of the people working for Amazon. And then finally, CapEx at 61 billion today, growing at 45% clip, gets you to $2.5 trillion in CapEx for that year, 10 years from now, which obviously that's a very large number. And then finally, market cap at 1.17 trillion today, thereabouts at a 24% CAGR, gets you to 10 trillion, and which is about 30% of today's S&P 500 market cap. So that's those are obviously some very, very large numbers that are implied if you were to use growth rates of the past to these various metrics. Okay, another analysis that I have that might be kind of interesting to see. I took the cumulative last 15 years of results and then compared those to different things. So in the last 15 years, Amazon has had $2.2 trillion of cumulative revenue that's come in over the last 15 years. Today's market cap at 1.17 trillion implies that it's a 1.8 basically cumulative revenue to today's market cap. So basically, like for every $1.80 that has come into revenue or come into Amazon over the last 15 years, you're paying $1 of market cap for that. Let's do a little for reference. Let's talk about Berkshire over the last 15 years. Revenue of $2.82 trillion. So actually, Berkshire's had more revenue over the last 15 years than Amazon, which might be a little bit surprising. And their price, based on a $600 billion market cap to 15 years worth of revenue, it's 4.71 times cumulative revenue to market cap. So basically, like $4.71 has come into the door over the last 15 years compared to every $1 of market cap assigned today. So, 4.7 versus 1.8 effectively. Now let's look at cash flow from operations, and cumulative last 15 years, Amazon's at 259 billion of cumulative over the last 15. And so that gives you a price to 15-year cumulative cash flow of 4.5. Whereas at Berkshire, it's 424 billion. So like almost double the amount of cash flow. And obviously on a much lower price. So you end up then at a 1.4 price to 15 years total cumulative cash flow. And then total CapEx actually is a little surprising. Last 15 years, 172 billion for Amazon and 163 billion for Berkshire. So actually kind of comparable revenue and CapEx over the last 15 years for two companies, but pretty dramatically different prices as far as what you're paying for that. So I don't know. I find that to be a little interesting, different analysis than what I've seen for Amazon.
Should be different. One's an insurance conglomerate with an old man running it, and the other's Amazon. I'll tell you what's beautiful that you missed. This is a thing of beauty. Hang on here. You got
it's got no real debt, does it?
Well, this is what I'm about to say.
Okay.
$10 billion of debt maturing after 2052. They issued 3.95 paper maturing 2052, 4.25 57, 2.7 at 60, 4.1 2062. Like, oh my God.
Should get those blokes running the treasury. I guess.
Good job to the CFO. Yeah.
Now do Berkshires.
Yeah. Well, they're doing a good job too. No doubt.
Zero.
Oh no, Berkshire's been issuing debt.
No. I mean, zero interest rate yen.
Oh, yeah. Yeah, the buff dog, he's a good financial analyst.
He knows.
I think Amazon has done a good job with their hand. I mean, if you're gonna put
for me.
step on the competition now,
use
the debt markets to fund it, especially if you think rates are going up.
What's Amazon's debt load? It's like basically immaterial, right?
Oh no, they got some debt.
How much is it?
I mean, I don't know, 30 billion or so.
Oh, okay, yeah. So in the context, I'm just looking at
market cap to
on JT's numbers, yeah. On JT's
no,
numbers,
142 billion, 82 billion of net debt. Sorry.
If you project forward on that analysis that you did, you get EBIT of 1.2 trillion by that terminal date and a market cap of 10 trillion. That's only on an 8x. That's like reasonably good value for something that big, I would have thought.
That's why Buffett's buying it.
Amazon?
Yeah.
That's one of the boys, isn't it? Ted or Todd?
Well, it's in the house.
And that's kind of interesting. So you could get reasonably high rates of growth out for a decade and still be on a modest. It's probably pretty good value. I like that analysis that the intrinsic value. I'm just forgetting that, blanking a little bit on the name of it.
Ensemble.
Yes, Ensemble. Thank you. Intrinsic. I think that's the name of the blog, right? Intrinsic.
Yeah, intrinsic investing. Yeah.
Just that they look at the subsequent the subsequent price performance or market capitalization performance to work out whether you overpaid or underpaid prospectively, which is kind of an interesting way of going about it. Obviously, you can't do that prospectively, but if you could pay a very high price for Coke and it still delivered ridiculous outperformance for that subsequent period. And Buffett didn't pay a very high price for it. So
yeah,
it's interesting. Maybe it's
you get your hands on, one of the best businesses of all time, you can probably pay a lot of money. It's just a question mark of how easy it is to identify those a priori. Yeah, and do you have a portfolio full of them is my other question.
Yeah.
Well, I mean, fair. I think, but Buffett would say you swing 20 times in your life, right? So I think that implies, if you believe that punch card quote and you live by it, that implies you're not going to have that many.
It's funny though, because I take the opposite view of that. I think that given the extreme outcomes, you're better off having more of them. You're better off taking I was going to say a VC type portfolio. I don't know how concentrated VCs are. I thought it used to be like 10 times 10 positions, which seems extremely concentrated to me. But
yeah, you want like 100 1% positions and that kind of distribution of returns.
That was the approach of blanking on all of these names now. What the Mark Andreessen's Y Combinator. That's not Andreessen's. Sorry, no. I got there anyway. Y Combinator.
Paul Graham,
yeah. Y Combinator has like $100,000 tickets, right, for 10 million in a year. I would love to see their returns. They must be astronomical.
Yeah, it makes sense. Shotgun approach.
Because some of them are going to be mistakes, but some of them, if they are geared up to perform, like they do have those monster returns in equity, big margins, high rates of growth, you are going to get, if they can sustain it, you get silly runaway returns at the end of it. Actually, did you know C's Candies was public when Buffett bought it?
I did not know that.
Was it?
According to I'll dig up the tweets I saw today. And so they paid for that. They paid whatever for the controlling interest, and then they bought out all of the minorities subsequently. But you could have bought Hershey's at about the same time. I think I sent this through to JT yesterday. Hershey's had a market cap of like $100 or $200 million at about the same time. Hershey's today is like $45 billion company, something like that. And it's been paying dividends the whole way through.
Let's say you hold the stock and a young Buffett gets control of it. Are you happy or are you worried?
How do we know that it's a young Buffett? Is it someone telling us that it's a young Buffett?
No, I'm just saying, like,
you know,
like I don't know. Let's say Ackman gets control of it.
Probably not the right example, but because my definition of a young Buffett is someone who, maybe he's changing his ways a little bit, but like someone who's just who's focused on the downside first, who's like risk focused, because I think that Ackman has sometimes tended to, like with Target and a few of those things, has just tended to swing for the fences.
My point is, I'm just not sure that, I mean, I'm not sure that as a minority shareholder, it felt like you were totally safe at all times. I mean, I've read, like he used to get super pissed off if his friends bought something in front of him. Like, I don't know. I don't know that you're.
That's in the snowball. Yeah.
You better I think you better be aligned. Maybe that's the best way to say.
Yeah. But I mean, Hershey's wasn't the story of Hershey. I mean, I'm guessing that there has been pretty good capital allocation there to get it to this point. But the story of Hershey's is not so much that it was great capital allocation. It was that it had all of those other qualities, right? That it was high returns and equities brand that everybody has these good feelings with. Like you could take the C's analysis and apply it to Hershey's, and it's also true.
Yeah, probably a little bit. I think C's was probably a prettier brand than Hershey's was at the time.
I would have said that Hershey's is more famous than C's, though.
Oh yeah, easily.
I'd heard of Hershey's. I'd never heard of C's until I started reading Buffett, and it came.
Yeah,
maybe not on the West Coast. Like C's probably gets tip of the cap, but Hershey's.
But outside the states,
you're gonna bring your wife a Hershey's kiss and get like love on for that.
No, but you're gonna buy a Hershey candy bar every single time you go to the store, and you're not going to buy C's every time you go to the store.
Yeah, but that's the thing, right? Like you're pricing your wife's happiness in C's. You're not pricing a commodity chocolate.
It's a gift, right? It's like C's is regarded as a gift.
Yeah, you want to go home and
so it doesn't matter if you overpay for a gift.
I think it matters, but I think that you have more pricing power in it. Yeah. Right. Because I mean, I've heard Charlie say that before. Like you get it, it's a special box.
Pricing power, but unit volumes, I think, are big differences there because the job to be done by each one of those is so different. Like you said, one is a gift and the other one is a self-indulgence.
I don't know. Rumor has it C's better invest in their stores if they want to keep that allure.
But that's always been the case, right? Like there's one near us that I go to occasionally to buy something for my wife. Exactly that.
Get down to the doghouse.
The thing is that like there's always quite a few people. I'm always surprised because it's this little like strip mall that it's housed in, and it's kind of basically this big store that's vastly empty and it's all white, but it's still full of people. Like and you pay when you buy them. I'm like, this is a good business.
There's
all margin.
The lottery is French, and they do what are those little French cookies? The hell are those?
Oh macaroons? I know. Yeah, I know what you mean.
That place, if I could own stock in that, and I was guaranteed that they wouldn't expand units too much, that's a hell of a business.
I was just about to, before you said that, I was just about to say if they can work out how to distribute those things, that's a good business.
No, they need to, but I wouldn't want them in every city. Like I think it's luxury cookies, man.
Isn't it interesting?
Can't have luxury cookies in freaking Alabama.
Well, macaroons, I guess they're just too hard to get them to
probably
stay puffed when they travel. Yeah.
You see it a lot. You see it. I think fast food is kind of regional in certain ways. Beer is definitely regional.
Yeah. But beer can travel. It's funny. We've gone through that. When I was a kid, beer was very regional. And then it went into
what were you
macro
drinking back then?
In Australia, Forex. Beer was very regional, and then it got consolidated because everybody could see that they were great businesses for leverage buyouts. They support debt, recession resistant. And then they became like macro brands. And then I guess some of that CPG flows through the beer companies as well, because they spend more on advertising, get the end caps in the aisles, all that sort of stuff. And then sometime over the last decade or so, people have just said too much macro. We want the microbreweries, or they changed one of the regulatory. There was a regulatory burden that microbreweries couldn't get over, and so they've now changed. So that's why you've seen the explosion in microbreweries everywhere.
Is it like distribution or something?
I'm not sure what it was. I don't know how they were. I don't know what the issue was, but I just remember reading that they had changed something which was too onerous for a microbrewery to get the license or something like that. Mm. So the microbreweries were still kind of big breweries, not like they are now.
And now they're getting all gobbled up too, huh? The microbreweries. So
it's the way of the world.
Just you're either bundling or unbundling at all times.
It's not a bad exit. I mean, it's not a bad exit rate. Foster's, Foster's the most un-Australian beer. That's right. We export that stuff, so we don't drink it ourselves.
Swill.
No, the commercials say you drink it, so you drink it.
Yeah.
Sorry.
We definitely do not.
It's
No, you
Australian
do.
for beer. Come on.
It's regional. Like if Victor Bravo, Victoria beer, and then I don't know what Sydney ciders drink, and then Forex in Queensland. I guess it's Swan, WA, something like that.
You know what
It's
I
been
like
a little
about
while.
Australia? I used to like paying before you eat, because then you're not sitting around waiting for the check and the tip. Is that just what I did? Is that not like a thing? So I did
you
it
go to the
like,
order from the counter.
yeah. I mean, I was at hostels and stuff, but it was like good food.
No, I think that
that's called Chipotle.
there is a more traditional kind of they bring the tab to your table.
No, well, I wouldn't like that.
I've got a little data point tweet from Economic that I thought was interesting.
Do we have any listeners from Byron Bay? I am willing to visit your house anytime you want me to.
I will
It's my
be there.
favorite
Actually,
place on earth.
I'll be back in Christmas. I'll be back around Christmas, so I'll be visiting Byron Bay.
So
Right.
badass.
Are
Nimbin,
you
you
gonna-
gonna hit up Nimbin?
I may have to. I don't know. We'll see. We'll see how we go.
Are we going to do the show? And it's going to be 3 a.m. for you.
I don't
It'll
know what we're
actually
gonna
be
do.
after hours.
It may be. It
Oh.
may be.
Uh-oh.
Start of the day from Jake at Economic. This is from Credit Suisse. Russell 2000 returned negative 23.5% over the last 12 months, which Solo Prosperity, good Twitter account,
Is that good?
pointed out that was my definition of a bear from last week. And this is how it broke down. It was composed of a 27.7% growth in earnings and a negative 40.9% multiple contraction. It's a tough game.
Ouch.
Off a low base too. That stung.
Right
See that? The
in
multiples
kisser.
expanded. They correctly projected the earnings growth, and then they got a little ahead of themselves. And here we
I don't know
are.
I don't know if they really were that far ahead of themselves because they were. Let me see if I can find that.
It is a tough game though. If I had told you a priori a year ago that here's what's going to happen, earnings are going to grow this much, you're like, I'm rich. This is all coming up. We're
I
on
got
it.
it right.
And then just
1
getting
year of earnings doesn't mean
monkey
anything.
hammered.
Though.
I know, but let's just indulge me in the intellectual exercise.
Yeah, I mean,
Everyone would have been like, yes, this is
For the
coming up
category.
Millhouse.
This is for the category. So the historical earnings growth in this category is 27.44, which I think is just a little bit different from what I said, but 27 was the right handle. Price earnings under 10, 9.95, price book 1.47, price sales 0.8, price cash flow 4.99, dividend yield 2.16. Those are pretty good numbers. I guess it's people they're much more volatile than the rest of the market. People get nervous going into recessions. Maybe that's what's happened.
Is it possible that E is a little overstimulated also?
That's possible. Yeah, I guess there's some sugar coming through. We've seen that hump in a whole lot of, I guess that hits the little guys more than the big guys. Maybe it hits everybody. I don't know, equally.
it'll hit them eventually.
Stimmy.
I saw another stat yesterday that said that the excess like savings or whatever, I don't know exactly how they categorize it, but it's like it was off the Richter scale through the 2020-21 period.
Yeah.
And it's now turned negative, but on a rolling 12-month, it's still higher than it's ever been. So we're working through it at the moment.
Yeah, well, that's the thing. That's what makes, I think, a lot of this so tough is the consumer's in very good shape. The consumer debt is, pretty, it's termed in a reasonable manner. It's not all adjustable rate. Jobs are pretty good. We'll see. I don't know. Good news is bad news. Bad news is good news, I guess. Go into a recession to get stocks up is a weird concept to me, but I guess I get it.
That tells you that we have too much federal intervention.
It's in everything. It's just, I remember.
I don't know that that's what it tells me. It tells me that people are way too focused on the short term.
Well, and
it's a little
what
bit
the Fed
hard.
is going to do in the event that bad news means that they come in more, right? And that becomes good.
That's got
news.
hard to predict. Yeah, good news is bad news is good news is bad news. You're like, 4 or 5 derivations deep on that one.
Yeah.
I don't know what Ed Hyman said lately. I haven't seen his stuff in a minute, but last I saw, he was not predicting an earnings recession. But if anyone sees it, send it over. I won't disclose who it is.
Well, there is a prediction of an earnings recession out there, because that was the Man Group one that I delivered a few weeks ago. Man Group said 190. So S&P 500 last quarter for trailing 12 months was $203, and they've got, based on a forward projection of, I don't know, they're using some economic indicator looking forward. They said 190, and that's where they get. That's where they get their 12 times on 190 is 2,300, and that gets you to a 2,000 low. That was their pitch. Actually, I saw one from John Hussman today. I know you're not allowed to quote Huss, but I thought this was kind of interesting.
It's a scarlet letter.
He says S&P 500 price to revenue ratio, not forecasts. This is TTM. I'm guessing 2000 peak 2.36. 2020 peak 2.42, 2022 peak record high 3.21, current level 2.28.
So we're back to 2000 is what he's saying basically today.
Yeah, well, a little bit below, but yeah, not much. 1982 low 0.33, 1990 low 0.62, 2002 low 1.15, 2009 low 0.68, 2020 low 1.6. This is why I think that it takes more than one bust to get us to like a table clearing number, because it's
so the
so high
argument against price to sales is that margins are
better
through the roof, so you can't really compare like for like. But still, that is a little bit of a troubling data set, isn't it?
But that margins through the roof, that's partial. That's a capital over labor argument, right? Which is reversible. And it has been a mean reverting series since the beginning of time, but not over the last decade or so.
He said mean reversion. What a bozo.
I don't even know money supply to total market cap. There's so much fucking money out there, and there's so many people that are doing this. I don't understand why the expectation of things get cheap. I mean, look, they may get cheap, and then the people that have been waiting, good for you. You had to sit out 15 years. Now you got your shot. Take it. But I just think that there's so much money out there that I don't know why people would expect for things to get egregiously cheap. But, if they do, I'll probably be crying without any money. And the person that waited said, see, I can dance on your grave. And I will say, good for you.
Well, it's not like there's much you can do anyway. It's not like you're going to, the time to sell out was, I don't know. There's been no good indicator to sell out.
Now you tell us.
It's definitely not now. Now is the best opportunity that we've seen in a long time. Now's the wrong time to be doing it. Forward returns
go a lot lower.
It could, but I'm just saying that forward returns when you get to these levels start looking pretty good.
They start getting to adequate, right?
Well, I guess it depends on what part of the market you're hunting. And if you're looking at the market, if you're looking at the index, and then again, the index is made up of, we just discussed Amazon, but we could have said the same thing for Microsoft or Google. That's a big part of the index. These are unusual businesses. We've already discussed that. It's possible the index does all right in defiance of Cape. Probably it's a better bunch of businesses. And it's not like you've got Exxon as the number one stock in there, which is selling a commodity. Then again, Vidad says it doesn't matter. It's a hard game, right?
Yeah. Exxon was a pretty good business for a long time too.
It is a good business. It's just that they're just taking prices though. That's the only problem. Whereas I guess Amazon's taking prices in some sense too, but Goog's probably setting their prices.
Well, the auction does, right?
But they're capturing a big chunk of the consumer surplus versus producer surplus there in their auctions for sure.
Not enough. Help them get more. Same with Microsoft. Microsoft needs more money too. Jeez.
Raise the price.
That's right. I'm still waiting to get a percentage of every transaction on the desktop.
Make all these capitalists richer.
That's right.
I wonder why Berkshire doesn't go and buy a whole lot of good. They've talked about it before. They clearly understand the economics of it. Was that a meeting a few years ago where they were talking about they could see how much they were paying for clicks with Geico?
we've talked about it multiple times in the
Yeah.
meetings.
Yeah. What's the reticence there, do you think? Not cheap enough? Like, I mean, looks pretty cheapish.
I don't
Yeah,
know.
it probably isn't cheap enough for the buff dog.
What do you think, JT?
I don't know. I think it's some combination of cheapness and size that makes them question. But I don't. They've been wrong and admitted they were wrong, and I think we've all, or at least I've admitted I was wrong. So I don't know. I don't know the real answer. Sucking your thumb.
Well,
the first
since
thing you almost said would be tough. Yeah, I don't know.
I feel reasonably positive about the returns for, I don't want to say value, but like just for things that have you can do a valuation on. Let me say that. So we're ignoring whether it's value or growth here, but it's fundamental. It's actually generating some earnings, throwing off some cash flow. Like, I do think those things they're cheapish at the moment. Well, they look pretty good value to me. It does depend a little bit on where interest rates get to, but there's a fair bit of headroom for some of those cheap ones.
Is it, to play devil's advocate, is it possible that there's some anchoring to the last few years of extreme prices that
teasing? Well, not so much the prices, but the E. Teasing out.
Valuations, I mean.
Teasing out the E is the difficult. Yeah, that's probably fair. It's cheap relative to where it has been for a while, but I think it's. I had a from October 9, 2020, when I was talking about something. I look at these the valuations are lower now than they were at that point, and all of the other metrics are roughly the same.
Okay. Based on October of 2020.
Yeah.
So 2 years ago.
Yeah.
Well, that's good news.
And I thought that was when I was like saying that I thought value was a big long at that point, because I thought it was unusually cheap. I don't know. It can't get a run on it. You get 6 months and then
Just falls
apart. Even though I think the underlying is performing, like as that Jacob economic illustrates, like the underlying is doing pretty well. It's just you got the multiple in your face all the time, the contraction in your face. Tobacco, energy, that's right.
Rising rates will do that to multiples.
Also true, but I think the bigger issue when you're doing the analysis is looking at trying to tease out that value. Trying to tease out that sugar rush from all of that stimmy that came through. Like all of those charts look exactly the same. Every single chart looks like a moonshot with a failed, exit from gravity and now return to gravity. Yeah. And who knows where the bottom of that is. And it showed up in the earnings, and it showed up in the multiples, and the multiples contracted first, and maybe the earnings are still returning to earth, and they got the multiple right for where the earnings are going to level out. So that's why it looks cheap, and it's not. But I still think the opportunity is pretty good. I think that everything points to better opportunities now than we've seen for a long time, a few years at least.
Yeah, that's good.
David Rosenberg says no.
Okay, he's said no for.
Nouriel Rabini also doesn't like it.
I would like to be the lone ball where everybody else is bearish. That would be fun. I hate being on the bearish side and having everybody else being bullish. It's much more fun being optimistic when everybody else is upset, which is why I like when the stock market goes down.
We'll get there. I mean, I think we'll be a good counterbalance at some point. I think we did.
We can't bottom
in March of 20. I think I went back and watched, and we were pretty positive and
that's good,
constructive.
I thought Berkshire was. I was tweeting about Berkshire at that time. I had a few people telling me that I had a few people telling me that the book value wasn't where you posted the book value because the underlying had also fallen. But even with that, it was as cheap as it's ever been on a price to book value basis. I thought that was about as easy as you get.
Yeah, that felt like a pretty safe, obvious thing to do, huh?
It's cheapish now too, even though it hasn't come back. It's not as cheap as it was then, but it's still cheap. I think it was 1.3 or 1.4 times book, which is not far north of web.
Yeah, it might be lower than that right now. Lower? Yeah, I think. Well, kind of hard to tell. Like you got to mark down the securities portfolio to something. So book value is moving on you.
On a
But they might.
prior
I mean,
Q.
I wouldn't be.
Basis.
Yeah, right. But it's possible that they're internally that they've been crushing enough to where it mutes some of that marketable security gyrations.
Fellas, we made it.
We made it. I think insurance has been doing well. I think the railroads probably doing pretty well.
Yeah.
I imagine BHE is doing just fine.
Mid-American.
Yeah.
Yeah. All right, fellas. Thanks so much, everybody. We'll
Cheers,
be back
everyone.
same bat channel.